Hey, it's Eric from Vertical Spread Options Trading. In this video, we're going to go over some resources I'm making available to you guys. I've used them for a while. I get a lot of questions about them. And the resources are a couple spreadsheets that are going to allow us to look at some price action analysis to use with our options trading. Now, this is primarily geared for credit spread or even strangle type sellers, people who sell options, specifically out of the money options. I think it's used best here. And I'm hoping that the price action part of that you can use in addition to your options trading. So, as option traders, most of us know that the options already have some built-in probabilities. And for one example, the best one, the one I use most is delta. And I know most of us know that delta is kind of how much the option will move according to how the underlying moves. But you notice all the options have different deltas, and the other thing that tells us is the loose probability of an option expiring in the money. So you'll hear guys talk about, or girls talk about selling credit spreads or selling naked puts or naked calls or whatever, and the probability, you can look at the delta. So if the delta says, a delta 20 call option, you're selling a delta 20 call option, whether it's a spread or not doesn't matter. But if you're selling that delta 20 call option, there's about a 20% chance that expires in the money, and that would be bad for your trade. So if you flip that around, there's an 80% chance that expires out of the money because it's a delta 20 option. So a lot of people will base their trades on just simply delta. I know that I do. So what we're going to add here, or something that I've sort of put together for you guys, is some resources for some of the major indexes, because I like to trade index options, and I'm looking at branching this out into other stocks as well. But basically, if you add consecutive day rallies or declines, depending on your bias, like if you rally 5 days in a row and then you want to sell a call spread, what's the probability of that staying out of the money? And instead of looking at options here, we're going to look at the actual price action or the actual closing prices of, we're going to look at SPY in this example, in the last 21 years. And we're going to talk about different date ranges, and you can change it if you think it's, for bull markets, you may want to do one thing. For bear markets, you may want to do something else. And I really think this can add an additional edge to your option trading. Again, primarily option selling. So there's 21 years in these spreadsheets, and I'm going to show you how to use them here in a second. And again, it can really sort of help you know when to enter a trade or help you give some idea of when you should. And also, again, helping you decide which strikes to select. And I know, some people get stuck on certain deltas, and that's fine. You want to sell delta 20, that's fine. But you can also use this additional data to reinforce your current strike selection, whatever method that is. So, all right, so that's it for the intro. Let's go ahead and dive into the spreadsheets. So we're going to first look at the SPY decline analysis spreadsheet. It's very important you know which one you're in, and it's very, very simple, and it's kind of it's not fancy. There's no super web GUI that you log into. This is a self-contained spreadsheet. You don't need to be online. It is in Excel. I believe you can read it in Google Docs as well. Don't quote me on that. But the way that it works here is, again, this is the date range of all the data. We have January 3rd, 1995 through December 31st, 2016. So it's about 21 years, give or take a couple days. And what we're going to be focused on for the price action is 2, 3, 4, and 5 day sell-offs. And the way that this works, and I'm going to do the super short version. For the decline, the trigger point is how many days in a row it sells off. So again, I have it set to 2. So for the past 21 years, when this is set to 2, this will tell you how many trigger points, meaning how many 2-day declines. Well, in the past 21 years, there's been 1,135 2-day declines. Now, quick kind of additional side note here is if you were to get a 3-day decline, that would add an additional 2-day because it just looks at how many 2 days decline. So a 3-day decline would actually contain 2-day declines. Just, keep that in mind. So, so the past 21 years, there's been 1,135 2-day declines. And then the next one is where's price going to be 30 days later? So the closing bar of that second day decline 30 days later, this is the up and down. So 30 days after the trigger point, remember the trigger point is the number of days it's been down, and the spreadsheet only contains 2, 3, and 4, and 5 days, is it up or down? Well, in the last 21 years, 30 days later, it's been above that level 65% of the time. And it's been below that level about 35% of the time. So again, and when you start thinking about credit spreads, you're like, okay, well, if I sell an option or I sell a credit spread, and we're just talking at the money now, is it above or below this point? And I'm not recommending this, but we know that if we sold an at the money credit spread, every time the market went down 2% of the time, or I'm sorry, 2 days in a row, 65% of the time, that credit spread would expire worthless 30 days later if it was a 30-day to expiration. So we can change that. We can say, well, what if I want to trade weekly options? Well, maybe I can do 7 days later. Okay, not as high, right? 60%. Maybe I want to do 3-day declines because I want volatility to really sort of be inflated so I can sell that premium. And I want to look at 45 days later because that's what I've learned on the internet. That's when you should sell credit spreads, or So again, you can look at this and see how far, or what the up and down ratio is according to the number of days down in a row, 3-day decline, and how many days later. So that's not really the exciting part. The exciting part is I want to sell an out of the money put spread because I'm a credit spread seller and I want high probability. So if I know, and that's where this percent of trigger point is. So when it's set to 1, it's looking at the close of that 3rd-day decline. But what I can do is say, okay, what if I sell one that's 3% lower? And depending on the volatility at the time, you may not be able to get a good credit. However, in volatile times, you can get a good credit 6 or 7% away. So this is where you kind of have to still use your common sense and still use your option trading skills to know if this is a good idea. But I'm just going to do an example. I know right now I'm doing this in this video in February 2018, and the market just had a big, mini crash pullback thing, and volatility is really high, and I can actually get a pretty good credit, 5% out of the money. And so if I do 0.95, that means 95% of that bar. So it's 5% lower than that 3rd-day decline. So this is a 5% out of the money. Now this spreadsheet isn't going to tell me what the delta is. I would still need to go to my brokerage account or trading platform and look at, okay, what's 5% lower? What's the credit? Maybe I can get a better credit 6% lower, 7% lower. But you can see what happens here. So on a 3-day decline, 45 days later, 85% of the time, the market's going to, the credit spread, if you will, would expire worthless if you sold it 5% out of the money. And that's really where you can gain that edge of saying, okay, well, maybe I can't get a credit there. Well, maybe you don't want to make that trade. Maybe the volatility is too low to sell that credit spread. What if the volatility was really high, like it is right now, and when I'm doing this video, and I can sell one that's maybe 8% out of the money? Maybe that's a delta 10, and maybe it's 90%. So, okay, yeah, maybe I should make that trade. Now, again, we're looking at 21 years, but the other thing you can do is change the range. So you can say, well, I think we're maybe we're headed into a bear market or a range-bound market, and you can change the dates. So let's do a quick example. I looked at the chart. I'm not going to go into it, but there was a significant sort of pullback and sideways choppy range for a couple years that started about the end of October 2014. So I'm going to enter that date in there, 10/31/2014. You see the numbers update here. And that lasted till about July 4th, 2016. And I just want to, you guys can look at the chart if you want, but I'm going to update those and say, okay, this is more of a range-bound market with some big dips and big moves. And if I were to sell the same type of option, what would probability be during this market time frame? So again, I can say, well, maybe I just want to look at 30 days later, and maybe I'm not going to get a good enough credit here. So I'm going to go back to like maybe a 0.95%. So again, during this time frame, if the market sold off 3 days in a row, 30 days later, those options would be out of the money 84% of the time if you sold something that's 5% out of the money. So again, this should be a supplement to your existing option trading strategies. Again, you still need to consider, is it worth selling? Are you getting enough credit? And that's something we talk about in our Facebook group. But I just wanted to give you these resources. I'm going to put a link in the bottom of this video on where you can get this. The rally spreadsheet, I'm not going to go over it right now, but it's the same thing. If you say, okay, if the market rallies 3 days in a row, is it above or down later? And you can kind of do some analysis there. So if you have any questions, let me know. Feel free to reach out to me in the Facebook group or in the comments of this video. And again, check the description for a link to pick up these spreadsheets. And that's all I got. You guys have a great day, and we'll see you at the next video.